welcome to the Monday edition of Dividend Cafe. We are into the month of August, and we started the month with a big sell-off on Friday, and then came back after the weekend with a big rally today. So as we kind of move a little deeper into the early part of August, a little higher volatility right now, but not a big net move. And it's an interesting story because more or less, what happened on Friday was that markets dropped after a very poor jobs report. And it rallied the bond market, and it caused stocks to drop. And then really the reason that stocks were up so much today was a significant repricing of expectations for a Fed rate cut. So those that are astute at the art of inductive reasoning could say, you're telling me that stocks went down on Friday for reason X and then went up on Monday for the same reason X. And there's kind of some truth to it, and it does seem a little bit incoherent. But I think a better way to put it would be that last week you saw a lot of volatility, and volatility is up and down movement, and this volatility is kind of continued here today, Monday, around what was a hawkish Fed press conference on Wednesday, but now very dovish Fed expectations today. What was very bad jobs report Friday, but what has been pretty good earnings season so far. Certain trade deals that have been announced, certain trade deals that remain unannounced. So whether it's jobs, rates, trade, and there's other categories too. Earnings are in this as well, because you've had some companies that came out with terrible results and got hit hard. Other companies that come out with very good results and rallied. You're seeing a bit of both extreme seasons of things on all of these categories. So you would expect that to enhance volatility. We're seeing that play out in markets. Before I go into today's summary, I would be remiss to not redirect you, if you missed it, to Friday's Dividend Cafe, trying to do an economic look at how to think about the tariffs and the trade deals further out. 6, 12, 18 months, what to expect, and what will represent a kind of fair litmus test for how it has played out. In some ways maybe better than expected, in other ways worse than expected. So I would direct you to Friday's Dividend Cafe for that treatment. The market today opened up about 300 points after the big sell-off we had on Friday, and then it went higher throughout the day and closed basically up near 600 points in the Dow, 1.34% to the upside for the Dow. The S&P up almost 1.5%, the NASDAQ up almost 2%. All indices up somewhat inverse to how much they were down on Friday, although actually the downside of last week was not fully recaptured today, but a good portion of it was, at least with the S&P and the NASDAQ. Despite the big sell-off in markets last week, the S&P was down 2.4% on the week. The market in July, the S&P, was up 2.2%. So I guess you could say it gave most of it back just on Friday and then had a rally today. But that speaks to the fact that July was a good month for risk assets without a lot of volatility. And then the heavy volatility of the last several days, you're going to see a lot of things go up and down almost by the amount that you saw in a whole month. And that's where we are with the S&P. Large cap stocks were one of the best performing asset classes in July. What we call frontier markets was actually at the top of the leaderboard, which is sort of the most emerging of the emerging markets, were the top performing asset class. MLPs were in second place, and I'm going to talk about that more in a moment. The worst were various elements of foreign bonds, foreign sovereign, emerging sovereign, the global debt that obviously trades inversely to the dollar. The dollar's comeback rally weighed on all those instruments that basically trade counter to the dollar. So remember, the dollar had been selling off in April, May, just June into July, but then really rallied. And that's what created that sell-off in a lot of foreign bond instruments. Speaking of bond instruments, our own U.S. Treasury 10-year, the yield closed today at 4.19%. That was down another 3 basis points. It had been down about 14 basis points on Friday. Some of the short-term, 1-year, 2-year, 3-year Treasuries, their yields were down 25 basis points on Friday. So just a massive rally over the last 2 days in the bond market. The top performing sector today was communications services, up 2.6%. Its cousin, technology, was up about 2.1% today. And all sectors were up in the market except for energy, which was down 44 basis points. That was the only sector in the red. One thing I want to caution you about, if you're reading other reports or if you are making the extremely unwise decision to get other financial sources of media and input besides the Dividend Cafe, that right now there's this theme I'm seeing more and more, both with institutional research that I read and even other media coverage of the seasonal conditions and what to expect, that there's a seasonal volatility this time of year in the VIX, and that this can be a seasonally challenging time for credit spreads. August is historically a difficult season for stock markets. I even saw that, and all those things I just said were quotes from various reports. I even read this morning that August in the second term of a presidency is historically a rough month. So, these things are almanac-type indicators that can be true and at the same time unbelievably unhelpful. That they do not take into account causation. They speak to certain correlations that lack causation, and even those correlations are not nearly all that high or helpful. I'd be very careful of seasonal discussion, which doesn't mean it can't play out. It just means I wouldn't bet on it playing out. On the public policy side, I do want to address the president's decision to have the head of the Bureau of Labor Statistics fired on Friday. It's a policy decision. There's a couple links in Dividend Cafe today to different op-eds and economic data and treatment of that whole decision and whatnot from Wall Street Journal and others. But I think it's going to be very consequential. I hope I'm wrong. I do believe that seasonal adjustments and revisions are unfortunate, but very, very common in what the BLS is attempting to decipher. The way it collects survey results from employers is subject to revision. There is absolutely no reason to believe this is new or partisan, that it has any precedent in history, recently or more than recently, in helping one political party over another. I happen to think what's kind of weird about this is that this particular revision helped the president in the sense that a narrative was cooked throughout May, June, and into July, because we didn't get this July report till early August, that, the economy was doing real well despite all the tariffs, and that was touted by his own economic policymakers and communicators time and time again. So if someone said, well, they were cooking the books politically, it would have been in his favor. And yet again, I don't think any of that was happening. There's ample precedent of these revisions being both upside and downside, being helpful or counter helpful to both political parties. And again, I think that they can be frustrating, but they are consistently applied in their model and methodology. Now you say, okay, well, I want to look for confirming data. That's fair. And here's some confirming data. The ADP private payrolls report, private payrolls, not going through Bureau of Labor Statistics or any other governmental office, reported a 3-month average of 37,000 jobs per month over the last 3 months in the private sector. The 6-month average had been 67,000, so that's been cut basically in half. The 12-month average was 130,000. So it's been cut in half twice over the last 3 months versus last year. And again, the ADP number could be wrong. I don't think anyone thinks it's being cooked. So we're dealing with a lot of different data points. While in the public policy front, I will point out that we have a framework of a deal now for trade with places like Japan, the UK, Vietnam, the European Union. There's still some unsettled things with Canada, and tariffs are supposed to now go to 35% with Canada, 39% with Switzerland. 20% tariffs are now effective with Taiwan, although those talks are still going on. I don't see that there are any constructive talks going on with Brazil. Those tariffs become very onerous. The only thing I want to say is when we talk about, well, now these countries are facing these larger tariffs in Canada and Brazil and everybody, it's fine. You can say that, and there's certainly a sense in which that language can have some technical accuracy to it. But these countries are not the only ones who will suffer from confusingly punitive new taxes. And this, of course, will have some cost to the United States as well, albeit much less of a cost than if we were dealing with the same thing with these larger trading partners like the European Union and Japan and so forth. So the jobs number that I mentioned created the controversy due to President Trump's decision to fire the head of BLS. It was a bombshell. 73,000 jobs created, much weaker than expected, but the far bigger factor was May and June being revised down by 258,000 jobs. A 3-month average of just 35,000 jobs per month. That's the lowest since COVID. That's sort of in line with what the ADP number indicates. The unemployment rate reaching 4.2%, so up just 0.1. Household survey saw a drop of 260,000 jobs. And then the labor participation force dropping to 62.2%. The small business data being where a lot of the difficulties lie. The NFIB, National Federation of Independent Businesses survey showing plans to add new jobs and increase wages at the lowest level it's been since 2016. The home building space is not allowed to update, not a lot to say on new housing starts, on new inventory, on new supply, on affordability, on price levels, and even mortgage rates. They're all kind of where they were, no new data report. But I will say that the home building sector as a public stock sector has taken a turn for the better, seems to have bottomed a bit and has formed a little bit of a formation toward, indicating coming off of its bottom. And if that proves to be constructive, markets are discounting mechanisms. And if it's forward looking, that this could be a good sign. I don't want to get ahead of ourselves. But it would be nice to believe that some of the worst is in terms of those other data points, whether it be affordability or new home construction. The odds of 2 rate cuts now, as far as the Fed goes, went from 48%, so 2 rate cuts before the end of the year, went from 48% after Chairman Powell's presser, meaning that there was about a 50% chance of only it was at 48 of 2 cuts, and it's now up to 81%. So you saw a massive move in the odds that there will be 2 cuts. And as I mentioned, the short end of the yield curve dropping 25 basis points. The bond market's certainly telling the Fed to get on with its in-cut rates. Now, I would say maybe even more interesting is that there's a 50% chance now for 3 cuts by the end of the year. That could be 1/2 a point cut and 1/4 point cut. It doesn't need to be 3, but there is a 50% chance of 75 basis points coming out of the yield curve of the Fed funds curve by the end of the year. We shall see. And then Fed Governor Adriana Kugler resigned Friday. The president gets a chance to replace her now. And will he choose to replace her with someone who would hold the seat and then become the new chairman? Once we see some of the nominees for the position, I'll have a better feel for that. It will be interesting. Oil down 1.7% today, sitting there still in that range, $66. Midstream last week was up 1.5% with the market down 2.5%. So some names coming in, good earnings results. Midstream mostly trading company by company in tandem with how their results come in. And the Ask TBG is a long enough answer as to how I would address whether or not tariffs are a good way to deal with government funding, whether tariffs are a good way to deal with other countries misbehaving. I will let you go to dividendcafe.com and the Ask TBG for my answer to that. So other than that, what's on deck this week is mostly more earnings, and I will look forward to being with you in the Dividend Cafe on Friday, as always, here in beautiful Newport Beach, California, where I have returned for the month of August. Thank you, as always, for listening. Thank you for watching, and thank you for reading the Dividend Cafe.